Good morning. The US economy continues to roar and it's having knock-on effects into bond markets. We're going to talk about why that is and what the market reaction is. Yesterday we had further evidence to suggest that the US economy continues to run at a pace that far exceeds other major developed economies. We had what is known as the business survey data, which is a monthly series that investors follow, which is yesterday the focus was on the services side of the economy. Now it's worth mentioning that services account for about 70% of the consumption within the US, so it is really important to get a gauge on the overall health of the US economy. When we look at the data, it showed that business activity is accelerating. We continue to see greater improvements, and we can see this on the chart in front of you where the business activity, you can see it with the blue line, is trending upwards. However, some of the challenge within the data that we saw within the survey is the prices component, which is the orange line, which you can see. You can see that has pushed now to its highest level since February 2023. Also within the report, we saw an improvement within new orders, and the employment picture continues to be stable. When we look at data also released yesterday, it showed that the number of job openings or vacancies came in at just over 8 million for November. This was much stronger than what analysts and economists had been expecting, and that suggests that the labour market remains firm. Now we're on the cusp of Donald Trump's president-elect, his inauguration in just under 2 weeks' time. His policies that he's talked about at great length is looking to reduce tax cuts and also apply tariffs on goods and services that are imported into the US. Now this is expected to juice the economy further, but it also risks inflation being slightly stronger and stickier in the future. So given the data that we've had over the last 24 hours and just this continued trend of economic strength, but also one eye on Trump's policies coming down the road, the bond market is somewhat fearful that the growth is too strong and that inflation will reaccelerate throughout the course of this year. Now we know last month we heard from the Federal Reserve, the US Central Bank, who revised its interest rate expectations, expecting only 0.5 percentage points of additional interest rate cuts this year rather than the initial 1% that was thought in September. So really the bond market is moving lower, or yields are moving higher. Now if we look at the widely followed the US government 10-year bond, its yield now at 4.7. Interestingly, that yields are pushing higher despite interest rate cuts over the last few months. Really what bond markets are really looking for is for the Federal Reserve to acknowledge the strength of the economy and perhaps put a pause on further interest rate cuts. Stocks, we also saw yesterday a little bit of weakness come through, somewhat challenged by bond yields pushing higher, but also some weakness within the major tech companies, the likes of Nvidia and Meta, who reported disappointing announcements. All eyes will be on Friday, where we'll get the latest jobs reports from the US with the official unemployment rate and the number of jobs added in December. Expectations are for the data to show that the labour market continues to be in good health. That's everything from us today. Thank you for watching, and we'll see you tomorrow.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.